to be baked in. My guess is unless something really untoward happens in the global economy or in the U.S. economy, which in the U.S. certainly there's no sign that something bad is going to happen, that we will have a couple more rate hikes, after which the Fed will look around and see, well, are we getting close? So around 2.753 is approximately where it will stop, maybe one more next year, and perhaps pause at that point and say we're closer to neutral than we were, and maybe we have to see the consequences because monetary policy has lags.
But we've seen a rout recently in emerging markets, and your successor, Ajit Patel, has come out to say that, the tapering pace of the Fed is to blame for what we've seen recently. Do you agree with that view?
Well, I don't know that, the liquidity in the financial markets has disappeared as of now. I think Dr. Patel is raising a question about going forward if there is a substantial withdrawal of liquidity, whether in fact it causes markets to tighten overly. But my guess at this point is the U.S. is focused on the growth of the domestic economy and thinks that inflation is pretty much where it wants it to be, and with labor markets at below what it thinks is consistent with full employment, that is at 3.7, this is a historic low, that really they're focused inwardly, and unless there's something big outside that happens to knock their sense of what is going to happen in the U.S., they're going to continue.
But having said that, should the Fed at least take cognizance of the rout that we saw in emerging markets? Well, bear that in mind.
I think that in a world where countries take full cognizance of the international responsibilities, one of the things that I have been pressing for is really the sense that the big central banks should look at the consequences of their actions also on other countries. That said, I think emerging markets are in a much better situation today, with a few exceptions where finances as well as politics are creating some uncertainty amongst international investors. But I think broadly they're in a much better situation than they were, say, around the time of the taper tantrum. That is not to say accidents cannot happen.
That's agreeing with the view of Jerome Powell, who said that emerging markets are in a good position to navigate the shifts in U.S. policy. When you talk about there are exceptions, which countries?
Well, first, I would say they're in a better position. I think there will be still stress for the emerging markets, and they will have to cope with the rising dollar as well as rising international interest rates, as well as the flow back of capital flows, which always happens at times like this. So there will be stresses. Of course, if you look around the world and you ask which countries are already stressed, you would say Argentina is stressed, and of course Turkey is undergoing some stress. The central bank has raised interest rates considerably, as well as simplified the interest rate structure. But I think in countries looking forward, of course Italy, depending on what the government does and how much it wants to break the fiscal constraints that the union puts on it and the euro area puts, that's going to be a place to watch. Brazil, where elections are coming up, and of course Brazil has a medium-term fiscal problem which it needs to resolve by dealing primarily with the pensions of public sector employees. That is going to face the next president. It's not going to happen before, but it's going to be something the next president will have to opine on very quickly, and that's something to watch out for. So there are countries that have issues that they have to deal with as we go forward.
You didn't mention any of the emerging markets in Asia.
Well, I think Asian emerging markets are in a healthier situation than in the past because of fairly narrow current account deficits, fairly small fiscal deficits, as well as moderate inflation. So there is more confidence in their currencies. Many of them have moved to inflation targeting regimes, and there is a sense that they're not going to let inflation get out of control. So they are in a different position. Again, I would say that some of them can get stressed. At this point, I would say, amongst the big ones, no clear and present danger.
You talked about Italy, and we saw the fallout from Italy throughout the world. 2 months ago, IMF chief Christine Lagarde did say that she was confident the Eurozone was on a sustainable path of growth. Does Italy change the prospects for Eurozone?
Well, I think certainly the advent of a populist government in Italy will raise the questions that have been raised and have quietened down, which is, what is the periphery getting? Now, in truth, the periphery has got a lot in terms of inheriting credible monetary policy, much lower interest rates than they were used to. But at this point, in a relative sense, when they look at the past, they feel that the exchange rate is stronger than they would like, and the benefits of low interest rates are being subverted to some extent by fears about these countries, and the spreads are widening. So on the one hand, we don't have as flexible an exchange rate as we would want. On the other hand, interest rates are higher for us than we would like relative to what they were in the past. And so our firms are paying these higher interest rates, are not being able to match competition from, say, Germany or the Netherlands. And so the core periphery sort of divide is growing again. Now, I mean, there is a dialogue to be had, but it is going to be a tough one.
Italy is one challenge. The other challenge is trade. U.S. and NAFTA, U.S. and China, and of course U.S. and its U.S. Steel and aluminum tariffs. Is Asia most at risk when it comes to concern of protectionism? Well,
unfortunately, accidents can happen. And the world is not well prepared for the entity at the center of the global financial and monetary order and trade order turning around and saying, I don't believe in all this, I want to change things. Now, the system has been built by the U.S. around the U.S. And now the U.S. actually doesn't believe in using the multilateral system. This is a very big change, and we're not prepared for it. Now, you would hope that good sense prevails, that some of what we see are bargaining tactics rather than actual threats which will be carried out. The problem, of course, is positions harden. You make a threat, somebody else makes a counter threat, soon you find you cannot back off. And then we get into, this is true of war, it's true of trade war. And one of the big worries is that threats are being made left, right, and center by sort of strong, I would say largely men, strong men who want to be seen as strong. And the room to back off is far more limited. And every country, whether democratic or authoritarian, essentially the governments want to look strong. So my worry is what you may think of as bargaining ploys, working out the art of the deal, soon becomes hardened positions which become very difficult to back off. And then you enter actual conflagration. And that, combined with the high degree of leverage and asset prices which are priced to perfection, that's a potent volatile combination.
Dr. Rajan, we had to leave it there for the moment. We'll be back with Dr. Raghuram Rajan just very shortly. We'll come to you live from the Nummu